Welcome back. Markets and fine. Federal leadership is squarely with the banking stocks. The RBI has remained on hold, but the stance remains accommodative. And on the whole, the policy has been far more dovish than what the street was anticipating, with special emphasis for housing finance companies, real estate companies, as well as NBFCs on the whole. Jigar Mistry now joins in to take forward the discussion on markets. Jigar, morning, and thanks so much for joining in. Would you look to buy housing finance companies or real estate companies based on what the RBI had to do and the demand push that they're trying to get through?
Good afternoon. I think if you look at the whole market, then there is one sector that hasn't participated at all. HDFC Bank, the Nifty market cap has actually passed the pre-COVID levels, whereas the banking index is down a large number. So it is one sector that needs recognition. Now RBI has taken part even before. So, all the measures that have been announced essentially start banking sector really getting invested in.
Jigar, we've got you on a bit of a scratchy line, so we'll try and reconnect with you perhaps on the phone. But it's clearly financials leading the charge. So the Nifty Bank is higher by more than 500 points. For those of you who've tuned in late, it's rallied close to 7% so far this week. And if you look at the Nifty gainers, it's all financials. It's HDFC Limited with a gain of 3.5%, taking its weekly rally to 13%. HDFC Bank, a big player in the retail housing finance market. So HDFC Bank has gained close to about 3.5%. HDFC Bank has rallied close to about 11% so far this week. ICICI Bank too has a fair portion of mortgage in its retail book, and that too is shining in trade and soaring. We're back with Jigar. We've reconnected with him. Jigar, you were telling us about housing finance companies and banks, and HDFC Bank in particular.
Yeah, sorry about that. What I was suggesting was that, if you look at the Nifty, that surpassed in market cap terms its pre-COVID level, whereas the banking index has not really been there. Other than HDFC Bank, most of the banks are still lagging. And RBI has been doing its part for a while. But what's really happening is that banks are, choosing to sit on a sizable liquidity. You are at 140 basis points of negative carry, and you are not finding enough avenues to lend. Now, combine that with the fact that, the investor deposits have sort of increased by 6 lakh crore over the last few months, and the spending is down 7 lakh crore. So I think RBI is right in pushing what they are pushing, but the demand needs to start from the ground up, which sadly is not yet happening. So we are choosing as of now to play this through the banking sector. We have discussed in the past that ICICI Bank, HDFC are some of our top picks in those names.
Okay, and what about real estate names? Because, the pricing could get a bit easier for high value loans if the developers choose to pass on the benefit. Do you think it will push luxury real estate?
Little difficult to say at this moment. I think that sector has been a little difficult to catch for us for a while. The pickup trade is now something that we are actively looking at, right? So the reopening trade is, you go back to March, and from March, the sectors that were responsible for 30% of the weight have driven 70% of the Nifty returns in the month since April to now. So the sectors that were 70% are only contributing 10 to 12%. So that's clearly something which needs to be invested into. Real estate is not really the pick. We might as well play it better through NBFCs, something like an HDFC Limited or some housing finance companies. But real estate for us is not really up there on the list.
And is the best of IT in the price now?
Yeah, so, TCS essentially had a stellar number. I think the other IT companies will more or less follow. But what we need to see is that the CNX IT index is up almost 30%. It's not just up, it's 30% higher than pre-COVID levels. And the earnings, they went down by, the CC growth went down by 7 to 8%. They have risen 4.8% for TCS, will be similar number for others. But the earnings are not yet reaching the FY20 number. So the sector has got re-rated in absence of growth plays that is sort of to be expected. But a large part of for us has been driven by rupee depreciation as well, and that's something combined with higher valuation is not a place which we find very comfortable post the recent run up. There are a few small cap names that we continue to own. We have discussed the Cyient in the past. That's one stock we continue to own. But within the large cap, I think valuation is getting a little bit stretched.
Thanks, Jigar, for joining in. That's Jigar Mistry, the co-founder of Buoyant Capital, with his views on the market. We'll wrap and get into a short break. We leave the mid-cap still trailing the frontliners. In fact, the mid-cap index is absolutely flat, and it has underperformed the large caps by nearly 4% so far this week. The advance decline ratio is still, however, in favor of the gaining side. Curtains down on this show. Stay with us. Halftime Report is back after a short break.